What is a capital structure and what does it have to do with debt and why is it relevant to you and your business? I'm James, this is the channel dedicated to the small and medium-sized business owner. Please subscribe to help the channel grow and keep the content coming. You may have heard the term capital structure or capital stack and want clarity on what this is exactly. This is essentially the collection of debt and equity that a business has. As a general rule, using more debt in the debt to equity ratio can help accelerate and turbocharge your returns, but it carries more risk. This is why some people love debt, because of the earning potential when used in the right way. Equity in this setting is either retained profits or infused capital from the owners. Some companies get very heavy into the financial engineering side of the balance sheet, working out how they can use debt to get the very best returns. And if you think about it, it makes sense. For example, if you can add 1 million of debt at 5% interest to the balance sheet, but your core business allows you to turn that 1 million into 2 million in the space of a year, you're essentially taking the lender's money, generating a return, paying back the lender with interest, and keeping all that excess that you would otherwise not have been able to generate. This is all fine and good, but market conditions can change. For example, I have seen some investment groups buy companies at a certain point in the market, lever up their balance sheet with debt to maximize their returns, only to see the market conditions change and the performance and profitability decline to a point where they can no longer service the debt. This is when you really get into trouble, because management's focus gets diverted away from making the best decisions for the long-term success of the company. An example of that would be pulling back on marketing expense so that next month's debt payment can be made. That is short-term thinking that hurts the long-term market positioning of the company and could actually accelerate the company's decline into distressed territory. So is debt inherently bad? No, it's a great tool for accelerating your wealth creation, but it does carry risk. In my opinion, it's best for small businesses to keep the capital structure as simple as possible. I'm not saying don't use debt, we certainly do, but you do not want to take your eye off the main thing, which is making sure your business is healthy and growing, to worry about maximizing debt and pushing the balance sheet to a point of unsustainability. Being crippled by debt is such a large topic that we'll be doing more videos on this and on different types of debt you can get in your business. But I do want to cover one thing briefly in this video if you already have or are considering adding debt to your business. Covenants. Make sure you know what your covenants are. If you have them, it will likely be debt to EBITDA or an interest or fixed charge coverage ratio that you have to maintain. Look at the debt documents to know how your lender is defining and calculating these. They may sound like complicated terms, but they are generally fairly simple to calculate once you step back from any jargon being used. If things were theoretically to go south in your business, debt holders take priority over equity holders for repayment. So make sure you get on top of your financing terms. What has your experience been with debt in your business? Have you been able to use it to get your business further ahead, or do you prefer not to use it at all? There is not one size fits all, so I'd love to hear in the comments. Thanks for watching, I'll see you next time.